Hold up right there, because something just went down with silver that most folks are going to completely misread. If you're holding even a tiny amount of this metal, what I'm about to break down matters big time for your wallet. Recently, silver took off like a rocket ship, then got slammed back down with the kind of violent swings that'll make your head spin. This wasn't some gentle dip or your typical red candle day on the charts. We're talking about the type of price action that makes confident traders suddenly second-guess everything they know, the kind that makes careful investors suddenly start panic buying at the worst possible moment. So what exactly just happened here? Silver just entered what traders call a high volatility momentum phase, where 8 to 10% daily swings can show up without any warning whatsoever. The market's starting to move like it's gearing up for a massive assault on that psychological $100 barrier. There's a hot zone target sitting near $106 that's acting like a giant magnet pulling price upward. But here's where things get twisted and complicated. The exact same volatility that could launch the next explosive leg higher is also the weapon that completely destroys late buyers and over-leveraged traders who got greedy. If you don't understand the mechanics behind these brutal smashes and deliberate shakeouts, you're going to get knocked out of your position right before the move you've been waiting months for finally happens. Let's dive into what's really driving this wild action. We'll explore which price levels matter for the next move and why these recent sell-offs are more mechanical than anything else. Gold is quietly sending signals that many folks are missing. Meanwhile, mining stocks are lagging, but this pattern could actually be super bullish for those who are patient. And at the very end, I'll give you the one critical rule that keeps you from turning a winning position into a painful round trip back to break even that destroys your account. Real quick, this is John speaking, and I seriously need your support for something that matters. I'm running an aggressive campaign to eliminate copycat channels that steal original content, repackage it, and repost it like they created it themselves. If you appreciate genuine content and real insights, smash that subscribe button and drop a comment saying AB so I can shout out the true supporters who've got my back. That single comment helps me push harder to clean up this space from thieves. Also, because I want to stay directly connected with the real audience, I created a dedicated WhatsApp channel for daily updates. You'll get quick market updates, links to fresh videos, and my personal thoughts on what I'm seeing unfold in real time. Check the link in the description below and join now so you're not caught off guard by big moves. Now let's dive straight into the market action that matters. Silver isn't leading the metals complex right now because it's entertaining or fun to watch. Silver's leading because capital is rotating hard out of stalled sectors and flooding into anything showing actual momentum. When equity markets chop sideways for months on end going nowhere, money starts looking for a new home that's actually moving. Right now, precious metals have captured that momentum in a big way. You can clearly see it in how attention has dramatically shifted across social media and trading forums. Silver, copper, resource company names, mining stocks, they're all creeping up everyone's priority watch list. Not because the fundamental news suddenly got prettier or more optimistic, but because the actual flow of capital changed direction. Silver is a particularly special case in this rotation because the market is incredibly small compared to other asset classes. When big institutional pools of money lean into a tiny market like silver, price doesn't crawl upward gradually. It lunges violently in both directions. That's exactly why silver can look boring and dead for weeks at a time, then suddenly feel like a rocket ship that caught fire overnight. But rocket ships shake violently during liftoff, and that's what we're seeing. When you witness repeated 10% moves happening back and forth over just days, it's definitely not random noise or coincidence. It usually signals serious crowding and positioning. Massive buying pressure collides head-on with massive selling pressure. Positioning gets extremely heavy on both sides of the trade. And heavy positioning almost always means the next directional move tends to be way bigger than most people are expecting or prepared for. Now, everyone watching wants the exact same answer to one question. Are we actually going to hit $100 or not? Here's how I think about this psychological level, honestly. $100 isn't some magic number with special powers, but human beings are wired to treat it like magic. Round numbers completely flip market psychology in predictable ways. $99 feels like just another number on a boring chart to most people. $100 feels like history being made in real time. When any market approaches a major round number during an active momentum phase, you typically get one of two distinct scenarios playing out. Story number one, the market punches straight through that level, triggers a massive wave of mainstream media headlines, and the late crowd floods in with FOMO buying. That surge of new money can fuel a fast extension even higher before anyone realizes what happened. Story number two, the market teases the breakout, gets everyone positioned for the move up, then rips violently lower in a brutal shakeout designed to create maximum psychological pain. You scare out existing holders who can't take the heat. You trap chasers who bought the fake breakout. And you completely reset all the leverage in the system by forcing liquidations. Both stories are completely possible outcomes here, and that's exactly why the real skill isn't predicting which one happens. The skill is preparing your account to survive either outcome without blowing up. Now let's talk specifically about that $106 area sitting above us. I'm not sitting here telling you it will definitely happen or giving you a guarantee. I'm explaining why it matters as a target level that affects trader behavior. Markets behave like magnets in momentum phases. Target levels become powerful magnets because traders front-run them with orders, algorithms react to them automatically, and social media turns them into a public scoreboard everyone's watching. Even if price never actually settles at that level and holds it, the market can spike toward it and reverse so fast your brain can't process what happened in real time. So if you're sitting here watching silver and imagining some clean, straight ride higher without any turbulence, forget that fantasy idea right now. The ride is going to be absolutely messy and chaotic. The payoff, if it actually comes wrapped in complete chaos that tests your emotional discipline. This is where the biggest misunderstanding about silver shows up in every comment section. Every single time silver dumps hard intraday, people immediately start screaming manipulation and conspiracies. Sometimes markets genuinely are unfair and rigged. That's absolutely true in certain cases. But a much cleaner explanation for many of these sharp, violent pullbacks is actually mechanical margin requirements, not manipulation. When volatility spikes higher, exchanges and brokers often increase margin requirements across the board to protect themselves. That means anyone using any amount of leverage suddenly needs way more cash posted to keep their positions open. If they don't have that extra cash sitting around immediately, they're forced to sell. Not because they changed their fundamental view or got scared, because the system literally demanded more collateral, or it closes their position automatically. And here's the critical part that most retail traders completely miss in their analysis. The people who are leveraged long in silver are usually leveraged across the entire precious metals complex simultaneously. If you're long silver with leverage, you're probably also long gold, maybe platinum, definitely mining stocks, and other resource equities in your portfolio. So when margin requirements rise across the board, forced selling spreads like wildfire. It hits the entire basket of related positions at the same exact time. That's precisely why you see these ugly red candles that feel like a coordinated attack happening, followed by recoveries that happen so fast it feels like nothing even occurred. The move down wasn't driven by some new fundamental narrative or bad news. It was purely plumbing and mechanics of the leverage system flushing itself out. This is also exactly why being directionally correct about where price is headed isn't nearly enough to make money. If your position size is too big or you're using too much leverage, a mechanical flush can remove you from the trade entirely before the actual trend you predicted resumes and proves you right. Now, while silver is stealing all the attention in headlines, gold is doing something extremely important in the background that smart money is watching closely. Gold has been acting way more like a staircase than a firework lately. Rally phase, pause, and consolidate. Rally phase, again, pause again. That specific rhythm matters a lot because genuine sustained bull markets almost never advance in straight lines. You don't get a smooth ride to the moon, you get waves and legs that build on each other over time. Many experienced traders are closely watching a zone around $5,100 to $5,200 as the next major area of price interest. Not a prophecy or guarantee, just an area where price might show a significant reaction. What I want you to notice carefully is the underlying structure forming. Higher highs being made, higher lows being respected, moving averages sloping cleanly upward, and pullbacks that look driven by news events rather than genuine trend-breaking weakness. And here's the mindset shift that changes absolutely everything about how you view this market. Gold isn't getting expensive at these levels. The currency you're measuring it with is getting weaker and losing purchasing power. Gold is simply the measuring stick that stays constant. The stick itself didn't magically change its properties. The paper units you're using to measure it did change and lost value. When it suddenly takes more dollars to buy the exact same ounce of physical metal, that's a purchasing power story about your currency, not a story about gold getting overvalued. That's exactly why people who treat precious metals as genuine long-term wealth insurance don't obsess over catching perfect entries. They obsess over staying financially solvent and staying positioned in the market through volatility. But in the shorter-term timeframes, yes, you absolutely still respect pullbacks. You still respect wild volatility that can shake you out. You still avoid chasing parabolic moves at the top. Now let's talk about mining stocks, because this is where retail investors get completely confused and frustrated. Before we go any deeper into miners, let me directly answer the two most common messages flooding my inbox this week. The first repeated question: if silver is supposedly so strong right now, why does it feel like the market is trying to violently throw me off my position every other trading day? Because the market's primary job is absolutely not to make you feel comfortable and confident. The market's job is to move price to whatever level it needs to reach to find the next wave of buyers or sellers. In these fast momentum phases, it finds those buyers by creating intense fear, then sudden relief, then fear again in rapid cycles. It's deliberate emotional conditioning designed to shake out weak hands. The second common message, should I be holding physical metal or should I be trading paper exposure through ETFs and futures? Here's my honest take on this debate. Physical metal is for people who want true ownership without someone else's promise or counterparty attached to their position. It's slower to trade, calmer to hold psychologically, and it's definitely not designed for rapid flipping and day trading. Paper exposure through ETFs or futures is for people who want instant liquidity and quick execution, but it comes with exchange rules, sudden margin requirement changes, and counterparty layers that can matter at the absolute worst possible time. So whichever path you personally choose, make sure it actually matches your personality and risk tolerance. If you can't sleep at night when price moves against you, don't use any leverage whatsoever. If you can't control your impulses to overtrade, don't chase breakouts with market orders. If you want to build genuine long-term wealth protection, think in terms of years and decades, not in terms of what happens next Tuesday. Now let me add one more critical piece of context that almost nobody talks about during parabolic price runs. A lot of traders treat increasing volatility as a clear signal to aggressively add more size because they think bigger moves automatically mean bigger opportunity for profits. And sometimes that's absolutely true in the moment, but bigger moves also mean your actual risk expands proportionally with them. Your stop loss has to widen significantly, your dollar swings per contract get way bigger, and suddenly what looked like a small conservative position becomes something that completely controls your emotional state and mood. So if you genuinely want to survive what's coming next in this market, you size down before you even think about sizing up. You earn the right to add to winners through disciplined risk management. You don't just demand it because you feel confident. And keep this reality firmly in mind. When silver finally hits the mainstream financial news headlines again, you're going to see nonstop stories about how it's severely overheated, how it's definitely time to take profits and lock in gains, how the absolute top is definitely in right now. Just like every other market cycle in history, the loudest voices and biggest media personalities will show up at the most emotionally extreme moment possible to tell you to sell. That's exactly why I want you laser focused on market structure instead of reacting to noise. Is the market still making higher lows on pullbacks? Are dips being aggressively bought by smart money? Are the sell-offs happening specifically on margin, flush events, and then recovering quickly? Those are the real tells that separate a healthy bull market from a dying one. Okay, back to mining stocks, because this confuses everyone. If precious metals are absolutely ripping higher, why aren't mining stocks flying the exact same way in lockstep? Because miners are actual operating businesses with costs and risks, not pure metal bars sitting in a vault. Miners have complex cost structures, serious political risk in different countries, operational risk from accidents, energy cost risk, and management execution risk, and mining stocks trade inside the broader equity ecosystem rather than as pure commodity plays. Physical metal can become a global flight to safety valve during crisis moments. Mining stocks can still get sold off like regular stocks during broader risk-off market moments. So minor underperformance compared to the metal doesn't automatically mean the entire metal move is fake or about to reverse. Sometimes it simply means big institutional money prefers the clean, pure exposure first by buying the physical metal itself. And sometimes it means the market is genuinely worried about profit margins getting squeezed. Energy costs matter tremendously to miners. Input costs for labor and equipment matter. A rising oil price environment can seriously pressure mining company margins, even as the metal prices they're selling rise simultaneously. That's exactly why miners don't behave like automatic leverage to the metal price. Sometimes they amplify moves beautifully. Sometimes they disappoint holders badly. Now, if you carefully study mining stock charts, you often see a specific pattern that's deliberately designed to completely break your confidence and force you out. A common one that repeats is the ABC correction wave structure. First sharp drop down, then a bounce that gives hope, then a final brutal flush lower that slightly undercuts the prior low by just enough to trigger stops. That last flush is the deliberate shakeout move. It triggers all the tight stop losses placed by retail. It convinces emotional traders the entire move is over and dead. Then it suddenly reverses and runs higher, leaving everyone behind. That's exactly why placing tight stops in a volatile bull market phase can actually be a serious liability. You think you're being smart and protecting yourself, but you're placing your exit order exactly where the market algorithms actively hunt for liquidity. So what should you actually do instead of guessing? You keep your entire process simple and mechanical. You don't try to become a fortune teller predicting every twist. You become a disciplined risk manager, asking the right questions. Is the primary trend still intact? Is market structure still holding key support levels? Are pullbacks mechanical flushes or genuine trend breaks? Are capital flows still rotating into this sector? Are buyers consistently stepping in aggressively on weakness? Now, I want to bring this entire analysis back to silver, because this is the absolute core of what matters right now. Silver is sitting in the exact zone where one single strong push can carry it cleanly through $100 and ignite the retail crowd with FOMO. If that breakout happens successfully, the next upside magnet target sits above and price can move way faster than logic or fundamentals suggest it should. But if that initial push fails to break through and hold, the market can still execute a savage dump first to shake everyone out, then make the real sustained move higher after it humiliates every participant. This is exactly why the next phase isn't simply about being bullish and buying. It's about being mentally prepared for extreme whiplash in both directions. Here are the two biggest ways people lose serious money, even in the best bull markets of their lifetime. Number one, they chase the breakout with pure emotion, size up way too much, and then get violently shaken out on the very first pullback that tests their resolve. Number two, they hold a genuinely good position, watch a big profit build up, get greedy and refuse to plan any exits, then watch those gains completely evaporate because parabolic moves always reverse violently without warning. So the real goal isn't to perfectly guess the exact peak price. The goal is to build a solid plan that survives both potential outcomes without destroying your account. If silver spikes higher, you already know exactly what you'll do with your position. If silver dumps hard, you already know exactly what you'll do. You don't make critical decisions in the heat of the moment because that moment is specifically designed by the market to trick you into the wrong choice. Now, I want you to do two specific things for me in the comments because it genuinely helps me shape what content I cover next. First question, do you think silver touches $100 cleanly on the first attempt? Or do you think it fakes everyone out with one brutal shakeout first? Second question, are you stacking physical metal in your safe, or are you trading paper exposure like ETFs, options contracts, or futures? Drop your honest answers below in the comments. And one more important thing, if you've been successful in any area of life, whether it's building a business, investing, career growth, side hustle, anything that genuinely changed your financial situation, share a quick story in the comments. Real people need real examples of success. Your story could raise someone else's confidence level today and change their entire trajectory. Now, quick creative detour, because some of you keep asking for more inspirational content beyond just charts. If you want silver-related success stories, real documented stories of regular people building actual wealth, learning hard lessons, and doing it step by step over time, there's another channel linked down in the description. If that style of content is your vibe, subscribe to that channel too and binge through the story library. It's a completely different style of content, but it's powerful and motivating. Back to the current market heat. The reason this exact moment feels so unreal and surreal is because silver is an absolutely tiny market relative to total global capital flows. When global institutional demand suddenly turns on and focuses on silver, there isn't much physical room or liquidity to absorb it. Price has to adjust extremely fast to find equilibrium, and that speed fundamentally changes human behavior in predictable ways. People start obsessively checking price charts all day long. People start refreshing their brokerage accounts every 5 minutes. People start doom scrolling through social media for any silver news. People start bragging about gains to friends. People start panicking about losses. And that's the exact moment when you stop rationally trading silver based on structure and start emotionally trading your own nervous system instead. So here's the one critical rule I promised you at the very start of this video. In parabolic market phases, you absolutely do not get paid for having false certainty. You get paid for following disciplined process consistently. Process means using position sizing you can actually hold through violent swings without panicking, having exposure that fits your actual life situation and risk tolerance, having a clear plan for handling volatility before it hits, and maintaining a genuine willingness to let the market prove the next step rather than forcing your predictions on it. If you're not in a silver position yet and you're feeling intense FOMO right now, don't impulsively chase. Markets almost always offer better entries through dips, consolidation periods, and shakeouts if you're patient enough to wait. Patience is your admission ticket to winning trades. If you're already in a position, don't let normal volatility bully you into making impulsive decisions that wreck your plan. Respect the wild swings, but don't surrender your original thesis and plan. And here's something specific to watch carefully over the next few trading sessions. If you see silver dip hard intraday and then snap back quickly before the close, that's a strong technical sign that demand is waiting under the market ready to buy. But if you see silver rally strongly and then stall for multiple consecutive days right under a key resistance level, that's the market loading the spring for a breakout attempt. Both setups can lead to explosive breakouts, but the path getting there will look completely different. So don't just mindlessly stare at the current price. Watch the market's reaction to moves. Watch how fast buyers respond to dips. Watch whether sell-offs get completely erased or whether they linger and build on each other. That reaction speed is often the real leading signal that matters most. And remember this, if you want me to cover specific silver trade setups, mining stock opportunities, or even detailed risk management examples, tell me clearly in the comments what you're currently holding and what time frame you care about. I'll pick several interesting comments, break down the situations, and turn them into dedicated future videos. Now we're getting close to the end here, and this is where I need to be completely blunt with everyone. My analytics stats show a weird reality that frustrates me. A huge number of people watch these videos. A lot of people clearly benefit from the analysis, and most still somehow don't subscribe to the channel. If this content genuinely helps you make better decisions, support the work by clicking subscribe right now. It's literally one single click. And if you want to actively back my campaign against copycat channels stealing content, comment AB so I can clearly see you supporting. That's your badge, showing you're real. Also, don't forget about the other videos. Subscribe immediately because daily updates keep you ahead of the emotional crowd that reacts late. Now here's the final cliffhanger thought to leave you with. If silver truly is entering that euphoric final zone before a major peak, the biggest updates and moves may arrive clustered together in rapid succession. Fast, chaotic, and completely impossible to perfectly time. And the people who ultimately win the most won't be the loudest voices on social media. They'll be the calmest traders because they'll already know deep down that volatility isn't a sign to panic. It's simply the price of admission to generational wealth transfers. So tell me honestly, do you think silver breaks $100 first on the next move? Or does it punish everyone with one more brutal shakeout before the real breakout happens?